Our latest quarterly business snapshot, looking at the period from July to September, showed an encouraging improvement in cash flow conditions, with business balance sheets, both for SMEs and commercials, also in solid shape. Our cash flow gauge, which is the ratio of revenues to expenses, rose 0.9% in the quarter. It is up 1% over the year, indicating that conditions are improving as the economy rebalances from public to private-led demand. 75 basis points worth of RBA rate cuts since February this year has helped, and debt servicing costs fell 1.1% in the most recent quarter. Now, as in previous quarters, the cash flow gauge increased even as revenues declined as expenses fell by more. For revenues, though, the pace of decline has decelerated, reflecting one, demand for goods and services has improved with a cyclical upswing in consumer spending underway, and two, the disinflation pulse has slowed, as evident by the stronger Q3 CPI print. On the other side of the ledger, total expenses fell 1.2%, with input goods prices in the manufacturing and construction sector down in the quarter. This was helped by an earlier Aussie dollar appreciation. Businesses' total wages bill also fell, consistent with the recent softening in the labour market. If we now look across industries, our industry cash flow gauge improved across 9 out of the 13 industries. Cash flow conditions in the non-market sector have outperformed since the pandemic, aided by fiscal support, and the health industry saw a solid pickup in Q3. But consumer-facing industries also recorded steady gains, given the upswing in the overall household spending. Still, there remain pockets of weakness, including the manufacturing sector, where sluggish investment in machinery and equipment is weighing on activity and offsetting robust food processing growth. What about cash flow conditions for SMEs and larger commercial businesses? The cash flow index for commercials rose in Q3 to its highest level since late 2023, and it's now back above its pre-pandemic level. And commercials are still willing to invest, with financing on plant and equipment 1.2 times higher than that for working capital. In comparison, the recovery of SMEs continues to lag that of the larger firms. But the SME cash flow index was broadly stable in the quarter, so it's holding on to recent gains, and was still up 1.2% in the first 3 quarters of 2025. More encouraging is that we are seeing a broadening in the recovery of SMEs across industries, with consumer-facing sectors, so that includes accommodation, recreation and retail trade, seeing more sustained gains. The share of SMEs with improving cash flow conditions compared to 6 months ago has also increased, marking the 4th consecutive quarter that more businesses are recording an improvement in cash flows. Now, this is not to say that SMEs are still not facing some challenges. Despite cost management and labour rationalisation, labour costs as a share of total SME expenses remains high at 8.2%. Now, that's about 1 percentage point higher compared to commercials and above its pre-pandemic levels. Now, also amplifying these cost pressures is lower relative productivity. In fact, we estimate that SMEs are on average 33% less productive than larger firms. So turning to what's happening across the states, we see cash flow conditions in Queensland and South Australia ahead of the pack, and both are above pre-pandemic levels. But New South Wales and Victoria are catching up. In contrast, WA was the only state to record a fall and has been treading water for much of the year, even as private demand is improving, as mining and agriculture export receipts have eased. So what can we expect ahead? Overall, we are now more confident in the rebalancing from public to private-led demand, especially around consumers and the housing market. This is spilling over to improved conditions, and we expect private investment to respond both to the net zero and AI structural shifts underway, as well as this stronger private demand, which will have positive spillovers more broadly. Now, there are still some uncertainties over the outlook, including the risk that the RBA keeps rates on hold for longer. Meanwhile, the surge in renewable and data centre investments poses challenges for a construction sector which is already facing supply constraints.